Today, we're going to be looking at Indian auto ancillary companies.
Oh,
And I know what you're thinking.
yeah,
What are those? Well, that's why we brought on an expert today. We
absolutely.
want to understand how these companies operate, right?
That's right.
So we're going to be exploring insights from a financial analyst and industry expert.
hmm
And this is Dr. Vijay Malik.
A brilliant mind.
He's analyzed hundreds of these companies, uncovering the traits, the hurdles,
Right.
the winning strategies that they use.
hmm
By the end of this deep dive, you'll have a solid grasp of this complex industry.
It's a really interesting sector.
Yeah.
People often think it's just about making car parts, but it's so much more intricate than that. There's so much to consider.
Yeah.
It's a delicate balance of economic forces, technological advancements, and relationships with some of the biggest players in the automotive world.
So let's dive right in.
Let's do it.
One of the first things that Dr. Malik points out is the cyclical nature of this business. It's like a roller coaster.
Yeah.
Periods of booming sales and high profits followed by inevitable dips.
Exactly. And this cyclicality is closely tied to the overall economic climate.
Oh, okay.
So when times are tough, people put off buying new vehicles.
Mm-hmm.
And this has a direct impact on auto ancillary companies.
That makes sense.
We see this really clearly when we look at companies like Jamna Auto Industries, which
Right.
makes suspension parts,
Right.
or India Nippon Electricals. They're a key player in ignition systems,
Uh-huh.
and their sales and profit margins over the years really show this pattern of peaks and valleys.
So it's not just about making a good product.
Right.
These companies are at the mercy of larger economic forces.
Absolutely.
And it sounds like they're under pressure from other directions too, right?
Oh, for sure.
Dr. Malik talks about their low bargaining power being squeezed between the big OEMs,
Mm-hmm.
the original equipment
They're
manufacturers
big guys.
who buy their parts, and the equally large raw material suppliers.
That's right. They're caught in a real vice.
Oh, wow.
Imagine trying to manage rising raw material costs while facing pressure from OEMs to keep your prices low.
Right.
I mean, maintaining a decent profit margin becomes a constant struggle.
Yeah.
Dr. Malik's research shows that if you see an ancillary company with unusually high margins, it's likely an anomaly.
Wow.
It's not a sustainable situation. OEMs keep a close eye on their suppliers' profits.
Right.
And if they see margins getting too high, they'll demand price cuts.
It's like under constant surveillance.
Yeah, pretty much.
And to add to the pressure, there's the just-in-time inventory approach that OEMs love.
Oh, yeah, that's a big one.
So not only are these companies squeezed on pricing, they also have to dance to the tune of the OEM's production schedules.
Exactly. OEMs want parts delivered right when they need them.
Mm-hmm.
It helps minimize their inventory costs.
Right.
But this puts the burden on the suppliers, forcing them to hold large quantities of inventory. And that ties up a lot of working capital, which can be a major challenge, especially for smaller companies.
It sounds incredibly risky, too.
It is.
What happens if an OEM suddenly cancels an order or reduces the quantity?
Yeah.
The supplier is left with all this excess inventory
Right.
and potentially financial penalties, too.
Absolutely. Companies like India Nippon Electricals
Okay.
and Minda Industries, a major manufacturer of switches and lighting systems.
Mm-hmm.
They're good examples of companies navigating this tightrope walk.
Yeah.
They have to be so agile and efficient to manage these demands.
So we're seeing this picture of a sector with this inherent instability,
Right.
intense pressure from both customers and suppliers,
Mm-hmm.
and the constant need to adapt to these demands of powerful OEMs.
It's tough business.
How do these companies even survive in such a cutthroat environment?
Well, Dr. Malik's research suggests that size plays a critical role.
Okay.
OEMs, they prefer to work with fewer, larger suppliers who can provide a wider range of products. This simplifies their supply chain and reduces their overall risk.
That makes sense from the OEM perspective.
Yeah.
But doesn't this preference for larger suppliers create a barrier for smaller companies
It certainly does.
to enter the market?
Yeah, larger suppliers have some key advantages.
Right.
They enjoy economies of scale,
Right.
which allows them to produce more cheaply.
Okay.
And they have greater bargaining power with both their customers and suppliers.
Mm-hmm.
And perhaps most importantly, they often get preferential treatment from those giant OEMs.
So it's like a self-fulfilling prophecy.
In a way,
The
yeah.
bigger you are, the more likely you are to succeed.
It's tough to compete with the big guys.
Is there any room for smaller players in this environment?
There are always exceptions, of course. But Dr. Malik's research shows a clear trend. Size matters,
Well,
and he highlights Minda Industries as a prime example.
Okay.
Over the past decade, they've grown aggressively,
Wow.
expanding from a 5% operating profit margin to an 11%.
Wow, that's huge.
They now have 62 plants globally, supplying a wide range of components.
Wow.
And this scale has helped them secure that coveted top-tier supplier status,
Mm-mm-mm.
with clients like Maruti Suzuki, India's largest car manufacturer.
So it seems like size and scale are essential for survival in this industry.
It's a big factor for sure.
But it's not just about being big, is it?
Right.
Technology and innovation must play a role as well.
Absolutely. And that brings us to another key insight from Dr. Malik's research.
Okay, we were just talking about the importance of size and scale, but it's not just about being big, is it?
No.
Technology and innovation
Right.
must play a crucial role as well.
Absolutely. Dr. Malik really emphasizes that companies producing technologically advanced products
Mm-hmm.
have a significant advantage in this industry.
Okay.
They can build these stronger relationships with OEMs
Right.
and often secure that preferential treatment in orders and command higher margins.
So it's a constant race to stay ahead of the curve.
It is. Think about it. New technologies are constantly emerging. Regulations are changing, like with emission standards.
Mhm.
Even customer expectations are evolving.
Right.
So these companies face this constant pressure to innovate and improve their offerings.
Are there any examples of companies that illustrate this point?
Yeah, Dr. Malik contrasts two companies in his research,
Okay.
Gandhi Special Tubes
Oh.
and Sharda Motor Industries.
Okay.
So Gandhi Special Tubes, they really struggled to adapt to new fuel injection technology, and ultimately they lost significant market share.
Wow.
Whereas Sharda Motor Industries,
Yeah.
they proactively developed products that met the BSBI emissions standards,
Okay.
and they reaped substantial rewards from that.
So it's a high-stakes game, innovate or become obsolete.
Pretty much.
But what about companies that maybe lack the resources for that extensive in-house R&D?
Yeah.
How do they keep up in this technology race?
That's where strategic partnerships and acquisitions come in.
Okay.
Dr. Malik highlights how these technical tie-ups with global players can be a game changer, especially for these Indian companies
Right.
that are looking to accelerate their technological advancement.
So it's like a shortcut to innovation.
Precisely by partnering with these established global players,
Right.
they gain access to cutting-edge technology.
Okay.
They attract global OEMs who are looking for those familiar suppliers.
Makes sense.
And it can potentially open doors to new markets.
You mentioned Minda Industries earlier.
Yeah.
Are they active in this space?
They are. They're a prime example of this strategy in action.
Okay.
They have this complex network of partnerships
Mm-hmm.
with global companies for various components like lighting, horns, sensors.
Wow.
And these partnerships have been instrumental in their rise
Yeah?
to becoming a key player in this Indian market.
But these partnerships and acquisitions aren't without their challenges, are they?
No, it's true.
Navigating these complex corporate structures,
Yeah.
integrating different business cultures.
It can be a headache. It can be a real headache.
Take Minda Industries, for example.
Okay. They have this sprawling structure with 42 subsidiaries, associates, and joint ventures.
Oh, wow.
So while this demonstrates their aggressive growth strategy,
Right.
it also makes it incredibly challenging for investors to truly assess their financial health.
So there's this trade-off.
Yeah.
Rapid growth through acquisitions
Mm-hmm.
can lead to this dominant market position,
For sure.
but it can also create this complex and potentially opaque corporate structure.
Right.
Makes you wonder if there are alternative paths to success in this industry.
Mm-hmm.
What about the aftermarket,
Yeah.
the replacement parts market?
The aftermarket.
Couldn't that be a way for these companies to diversify their revenue streams and potentially achieve those higher margins?
It's certainly an attractive prospect. Aftermarket sales tend to be less cyclical than OEM sales.
Okay.
And companies have more control over pricing in this segment.
But I'm guessing there's some significant challenges in this space as well.
Oh, there are. The aftermarket is incredibly competitive.
Oh.
Large, unorganized sector.
Mm-hmm.
A flood of imports.
Right.
And buyers in this market are extremely price sensitive.
Right.
So it's difficult to command premium prices.
So it's not as simple as just shifting focus to the aftermarket.
No, it's not.
Are there any examples of companies that have tried this approach?
Yeah. Gemna Auto Industries, which we mentioned earlier.
Yeah.
They invested heavily in trying to build a presence in the aftermarket over the past decade,
Okay.
but they failed to achieve meaningful scale,
Wow.
which highlights the difficulties of cracking this market.
So even a well-established company like Jamna Auto couldn't make it work.
They couldn't crack it.
That's telling.
It is.
Seems like building and maintaining strong relationships with those OEMs
Yeah.
is crucial for success in this industry.
It's certainly a key factor.
Companies like India Nippon Electricals, who we talked about,
Uh,
who focus on their core strength,
mm-hmm.
their OEM relationships,
Yeah.
and minimize their exposure to the volatile aftermarket,
Right.
have generally fared better.
Yeah, they have.
It's a strategic choice, isn't it?
It is.
Do you try to conquer that challenging aftermarket or double down on your existing OEM partnerships?
Right.
Seems like there's no easy answer.
Exactly. And this leads us to another crucial aspect that Dr. Malik highlights in his research.
Okay. So we've been talking about these strategic choices that these companies face, right?
Right.
Focusing on OEM relationships, venturing into the aftermarket,
Yeah.
navigating the complexities of these partnerships and acquisitions.
All important factors.
Is there any other factor that gives certain companies a distinct edge in this industry?
There is. Dr. Malik's research points to another often overlooked advantage,
Okay.
and that's OEM affiliation.
OEM affiliation.
Yeah. So companies that are actually part of an OEM group, either as subsidiaries or promoter group companies,
Right.
they have this built-in advantage in the market.
Like having a VIP pass, right?
Exactly. They get preferential treatment,
Mm-hmm.
assured business, access to the latest technology. Yeah, it's significant. They benefit from their parent company's established relationships,
Right.
their distribution networks,
Yeah.
even their bargaining power with raw materials suppliers.
Wow.
So it's a significant advantage.
in such a competitive landscape.
Absolutely.
Yeah, that makes sense. But for companies outside of these OEM families,
Right.
it sounds like it's this constant uphill battle.
Yeah, it's tough.
You're investing heavily in new plants,
Mm-hmm.
managing huge inventories, offering generous credit terms to their customers,
Right. Oh,
all while facing this pressure to keep prices low.
it's a squeeze.
Dr. Malik's analysis paints a pretty challenging financial picture for many of these companies, doesn't it?
It does. He analyzed the financials of over 2,800 listed companies
Wow.
and found a recurring theme.
Okay.
Most auto ancillary companies struggle with these low profit margins,
Yeah.
negative free cash flow, and mounting debt.
Wait, negative free cash flow.
Yeah.
What does that mean exactly?
Good question. So, free cash flow is essentially the cash a company has left over after paying for its operating expenses and capital expenditures.
Okay.
So negative free cash flow means that a company is spending more cash than it's generating,
Right.
which can be a red flag for investors.
So even though these companies might be generating revenue,
Yeah,
they're not necessarily generating cash.
right.
That sounds unsustainable.
It can be. It suggests that companies are relying on external financing, like debt,
Right.
to fund their operations and their growth,
Yeah.
which adds another layer of risk.
It paints a pretty challenging picture for this industry.
It's a tough one.
Are there any companies that maybe buck this trend?
Oh, of course, there are always outliers,
Yeah.
companies that defy the odds
Yeah.
and achieve this exceptional performance.
Right.
But Dr. Malik's research suggests that these are the exceptions,
Right.
not the rule. And that's an important insight for
Yeah.
anyone trying to understand this complex industry.
As we wrap up our deep dive into
Right.
the world of Indian auto ancillary companies,
Yeah.
we're left with this sense of both the opportunities and the challenges that define this sector.
For sure.
A market characterized by these cyclical swings,
Yeah.
intense competition, and this constant need to adapt and innovate.
Absolutely. And with the global automotive industry undergoing this rapid transformation,
Right.
the future of the Indian auto ancillary sector is more uncertain than ever.
The big question is, what does the future hold?
Right.
Will companies like Minda Industries,
Yeah.
who have pursued this aggressive growth through acquisitions and global partnerships, become the dominant force in the industry?
Right.
Or will the focus remain on nurturing those critical relationships with those large Indian OEMs?
Yeah. Those are the big questions.
Only time will tell.
Yeah.
But I think these insights we've discussed today give you a solid framework
I think so too.
for understanding this complex sector.
Yeah.
Yeah, we've explored these challenges these companies face, the strategies they employ,
Right.
and those key factors that influence their success.
Absolutely.
And now, armed with this knowledge, it's up to you to connect the dots,
Yeah,
draw your own conclusions,
for sure.
and maybe even predict where this industry is headed next.
Keep asking those questions.
Yeah, keep exploring.
Keep diving deep.
And on that note, we'll leave you to ponder the future of the Indian auto ancillary industry.
Absolutely.
Thanks for joining us on The Deep Dive.